And whenever a company cuts its dividends, investors might become disappointed. They tend to sell off their position, they dump the stock of the company, and as a result, the company's price will plummet almost instantly. That's the normal reaction. So in this video, I want to actually, assess the impact of dividend cuts on stock prices. What investors needs to know, and I want to discuss this topic under a number of subheadings. Number one is historical reaction to dividend cuts. Historical reaction to dividend cuts. So we need to analyze how the stock has reacted to previous dividend cuts. So in many cases, you discover that dividend cuts signals financial trouble, which can lead to a sharp drop in stock prices. However, in some cases, a company may cut dividends to reinvest in growth or to reduce outstanding debts, which could positively impact the stock price in the long run. It all depends on why the company decides to cut its dividend. If it is they want to reduce debt and maybe fund expansion, that would ultimately go well with the stock price in the future. If it's as a result of maybe the company is facing financial difficulties, then investors will sense that and then react by bailing out of the company stocks, and that will cause the company stocks to drop tremendously. Number two is a reason for the dividend cuts. It's very important actually. So understanding why the dividends is being cut is crucial. It's very, very important. You ask yourself why did the company decide to cut its dividends. So if the cut is due to a temporary issue, for example, a downturn in the economy or an isolated financial setback, well, that's understandable. The market may view it, as a short-term measure, and the stock price might recover, once conditions improve. A cut due to poor earning, that's a fundamental matter. If the cut is due to poor earnings or maybe high debt levels or a permanent shift in the business strategy, this may signal a long-term problem, and could lead to, a more sustained drop in stock prices. It will then cause the stock price to drop in a sustainable, pattern, in a sustained pattern. Number three is a market sentiments. And so the broader market sentiment may play a significant role. Mind you, you need to remember the fact that, apart from the normal company fundamentals, which is the more solid factors that tends to influence stock prices, investor sentiment, fear, greed, optimism, pessimism, all these factors come together to influence, the stock price one way or the other. And so even the market is already bearish, or even the cuts happens during a period of economic downturn or economic uncertainty, the stock price may fall even further. If the company is experiencing financial problems, the stock price could continue to fall. On the other hand, if investors see the cuts as a strategic move to strengthen the company's financial position, then the stock price may hold steady or even rise depending on the reason for the cuts and market participants' perception of what is actually happening. Number four is impact on dividend yield. Impacts on dividend yield. You know, a dividend cut usually leads to a higher dividend yield, since the stock price tends to drop after the cut. So while this might initially seem attractive to some investors, it's important to weigh these against the sustainability of future dividends and the overall health of the company. When the company start cutting dividends, it's important, investors look into what actually is happening. All right. If it's something positive, fine. It may not really affect the stock price so much, you know, in the downside. But if something negative, then the stock price may nosedive. It all depends on how investors, process and react to what is happening, within the company. Please like this video and subscribe to this channel. It will do me a ton of good. Number 5 is financial financial health and cash flow. Financial health and cash flow. So in this case, you need to assess the company's overall financial health, including its cash flow. You consider the debt level and even the profit margin. Does it have a wider or a thinner, slimmer profit margin? You consider all these factors. As a company with a strong cash flow and manageable debt may recover quickly from dividend cuts, whereas a company struggling with its finance may continue to face challenges that hurt the stock price further. So it's a matter of assessing precisely what is happening and then knowing how to react in accordance to the company's and financial condition. So this need for you to understand precisely why the dividend cut is in place, and then assess other investor sentiments towards it, and that would give you the direction or the action you need to take as regards to what actually is happening in the company, happening to the company's stock price. Number six is investor reaction and long-term outlook. Investor reaction and long-term outlook. So consider how long-term investors might react to the dividend cuts. How do they react? Because long-term investors actually are the real backbone of the company when it comes to investing. For example, income-focused investors who rely on dividends, for steady income may sell off their shares, causing a sharp drop in the price, in stock price. Those who are there for the income, they are there for the regular cash flow. They may get disappointed and sell off their positions. So that would lead the stock price to cause the stock price to fall further. Alternatively, growth investors may see the cut as a signal that the company is prioritizing long-term growth, which could establish or even increase the stock price over time. It could kind of either stabilize or leads to an increased stock price over time, depending on how long-term investors interpret the entire scenario. When short-term investors or dividends, or income, income investors have, abandoned the companies. So long-term investors will continue holding their stocks because they believe that eventually everything will fall in place and the company will recover. The stock price will equally, do well. Please like this video and subscribe to this channel if you've not done that. Number 7 is analyst ratings and market reports. analyst ratings and market report. You need to pay attention to analyst opinions as well as market reports, following a dividend cut, because they are likely to analyze and give reasons, or you know, uh, examine the reason why the dividend cut was carried out. So a downgrade or negative outlook from analysts can lead to further price decline. It all depends on the outcome of analyst, analysis of the company. And so conversely, a positive assessment, such as a belief that the cut will lead to a stronger company financials in the future, could mitigate the initial negative reactors that income focused investors tend to generate. Once it's a dividend cut, bam, they will just rush and they will sell, because the reason why they are in the company, the reason why they are invested in the company is no longer sustainable. No dividends to fall back on. They simply sell their positions and then go for the next available dividend paying stocks. So in summary, assessing the impact of dividend cut on stock prices requires a careful evaluation, of the reason behind the cuts. That's very important. Why did the company, carry out? Why did they carry out a dividend cut? The company's financial health. You consider the historical trends, the broader market sentiments. Factors you need to take notes of. So while dividend cuts can often signal trouble and leads to a drop in stock price, they can also be a part of a company's strategy to improve, to improve long-term company stability, to even improve its financials, in the long term.